Okay, so let's cover what happened this last week. Looking forward to what's happening next week, and my commentary will begin with good news is bad news, and bad news is bad news. And that's kind of sums up the week as far as what happened from an economic picture and from a market picture for that matter. So the first thing that came out that really affected the market, well, was a combination of things, but what were retail sales numbers were relatively weak for Walmart and Home Depot. And but what really seemed to drive it was the S&P global PMI number, and there's a difference between that one and the ISM. Uh, but I'm not going to get into all that. I'll explain a little bit about the ISM this week. And they came out stronger than expected. I mean, the consensus was for manufacturing was 47.1. It came out 47.8. And just taking a look at the numbers, you mean it looks like things are getting better, which means that the uh, Fed will probably continue to raise, or that's the expectation of the markets. And the same with the composite and the services portion all went up. The services much stronger than expected, and this kind of led to a sell-off in the markets. I didn't really pay much attention to the FOMC minutes. It didn't seem to have a huge effect on, everybody knows what they're going to say. They're going to continue to raise rates and maybe, 3/4 a point. I don't think they'll do anything more than that at this juncture unless the numbers continue to get stronger. But I don't get it. These numbers don't reflect, in my opinion, what's actually happening in our economy. But it is what it is. So, um, you know, the S&P came out strong. The market tanked. We'll just kind of take a look at the numbers here on Tuesday, which had been this day, and down went the market, and was not a great day. I mean, in general. So um, and it just kind of set the tone for the whole week. Although each time things got fought back. But we'll revisit this chart a little bit later. So that was Tuesday, and like I said, Wednesday. Don't pay much attention there, but the mortgage rates now have started to go back up, and this is one of the things that's going to start to affect things like durable goods, housing starts, and things like that. And higher interest rates is bad news both for the market and for the economy in general, because these mortgage rates, if people aren't buying homes and moving in, they're not buying furniture, they're not buying a whole series of things that you need associated with a home. Furniture, washer and dryer, dishwasher, all those things. So that was Wednesday. Thursday, there wasn't a lot. The jobless claims, I keep waiting for that number to go up, but that really didn't affect things. Everything seemed to be a hangover from Tuesday, as why the markets went down from an economic standpoint. And then Friday, personal spending, uh, you know, was stronger than expected. 1.3% versus 1.8. Take a look at the month over month numbers here. It started negative, and that to me more reflected what's going on. But this number is that because we're paying more? I mean, there's more to this number than what we can see. But I mean, that's a that's a pretty big jump for what it's been running. So we'll get adjusted. I don't know. Anyway, per spending was up, and that was a negative for the markets. And then obviously, when core PCE came out, the expected was 0.4% to stay consistent with the first month. It came out 0.6, and the markets went down. Pre-market, that was when the number was reported, and the market just went down all day. Tried to make a little bit of comeback, and then closed closer to the not well, probably about halfway, but closer to the bottom half of what it traded the entire day for the S&P and the Dow Jones. And just kind of, talking about these ISM numbers. Well, let me get to next week first, and then we'll get into that because I think it'll make a little bit more sense. So we have durable goods orders will be reported on Monday. Expected -4% is the expectation. You're going to get things on pending home sales, and one of the things we're starting to see is some of these home sales, new home sales too, getting canceled because the interest rates, or approval or whatever it might be, are killing off some of what we think is strong new home sales. But existing home sales are definitely down. But these things could get adjusted as people drop out because they can't afford the new home that they're trying to purchase. Wednesday, ISM manufacturing PMI, and now this is what the graph I just put up. One is the S&P 500. That was the one that was reported last week. And then there's the U.S. ISM Manufacturing Index, which is actually the one I've always kind of followed. So in the purple is the S&P that was reported last week. That kind of drove the markets down. And then the yellow or gold, excuse me, went down, and you can see the differences between the S&P 500 and the U.S. ISM manufacturing. Now, the ISM manufacturing, anything less than 50 is considered contracting. So you can see from this scale on this side, we're less than 50% on the ISM means that manufacturing is contracting. And what it's made up of are production levels, new orders, deliveries, inventories, employment. It's all combined into this number, and whether things are expanding or contracting. So it's contracting in that particular area. You get a number up above 50, let's say this coming week in the ISM, then you're going to see probably the market sell off and interest rates go up and the dollar gets stronger, all the things that go along with the Fed raising rates more. So that is the ISM, and you can see they pretty much move together. I mean, there's some gaps in here, but they all seem to cross each other and get back to each other at one point. I just got curious about how different the two things were. If you look at investor sentiment, it really dropped in the investor sentiment survey. And again, this comes out on Wednesdays after markets and close, and 28.8% on the week before on 2/15, and now we have 38.6% bullish. So people are bearish, and so we got a more bearish sentiment starting in, which personally I like, because the more bearish things gets, the better. But this conflicted with the fear and greed index. So this is the fear and greed index from CNBC, and you can see we're hanging in there, and greed at 59, which kind of surprised me because the whole week was kind of a down, kind of a negative week for markets. And I'm a little dumbfounded by this number at this point. I would expect this to continue to weaken, especially after yesterday. But it keeps up pretty much. It's not a lag, it doesn't lag that much. Like you only get the once a week snapshot with the investor sentiment. This is pretty much upgraded as you go. So I would expect this number to continue to go down. But the fact that it's there, it is what it is, I guess. So that is investor sentiment. We look at this coming week, or excuse me, some of the activity in the Dow Jones. You can just see how precarious we are about things getting a lot worse. We're here at I just kind of drew a line through this confluence here of lines, and I think we get below this 32,667 mark or so, then you're probably going to drop down somewhere, around 32,000 or a little bit under that, and hit this particular support level. But it keeps fighting it. You can see the last Thursday and Friday it kept fighting uh, away from this line, but it also kept kind of going down. And we look at the SPY; it's really in a precarious spot in that we are right in between this long-term trend line down that started back in January of last year that we finally broke, and now we're up against it. We actually went below it on Friday, and it recovered back kind of in between. I thought it might recover here, and then late in the day, it kind of tanked down. So it's a couple dollars from this green uptrend line, which we would be helpful to if you're a bull. Then if you're a bear, then you wanted to get below this white line here, um, and then you're probably dropping down to what 387, 388, somewhere in that before things get really ugly, and it could bounce from here. But like I said, the markets are in a very interesting spot from a technical analysis standpoint. And then we have the U.S. 10-year, which has been going up, but it still hasn't hit that 4% level. We've stayed below it. What are we developing here? I don't know, but double bottom possibly down here. Um, but here we go. It's attempted a couple times, but it's gotten rejected. So what will we see? Do we see it rejected? If it gets rejected, then markets go up. It keeps going up above this 4%. Markets are going to go down. We look at the DXY. It's in the danger zone right now at 105.26. Starts to break up through here, then again markets and the 10-year probably move pretty much together, and if it breaks through here, then you can expect the markets to go down. If it gets rejected back down in here, then you can expect the markets to go up. And crude oil is in this kind of cone area here, waiting. It's either going to break up through here eventually because it's running out of space, and it's either going to break up or it's going to break down in this. But it's the day of reckoning is coming for oil. The expectation is that it will go down, but we have to see. The VIX, which measures the volatility, has gone back up over the 20 mark. To me, between 20 and 24 is kind of no man's land. It's if it's above here, I'm usually selling calls and puts, and if it's below here, I'm buying them. If it's in here, I just kind of have to look at the individual underlying stock or ETF or whatever it is I'm looking at. So that's the VIX. And then we look at the put call ratio. Now all of a sudden we got this thing going back up again, although it closed at the bottom. But again, anything over 0.7 is considered to be bearish. And we're we're moving our way back up. So that's really it that I wanted to cover, at least for the economics and the market. My final comment is this: I have an interesting dilemma with regards to the kind of a couple of gurus that I follow. Everybody else kind of has there are different camps, but I'm kind of the contrarian person. And Peter Schiff is the Austrian economic type of guy that I follow, and he's ready. He believes these markets are going to tank, and they've got the inflation rate all wrong. They being the Fed, and then you've got David Hunter, who is the other side, who's calls himself the contrarian. I've done a episode on him. But he believes that inflation is actually backing off, and that we'll see this by virtue of the inflation showing to be backing off. We'll get this new all-time high and a melt up after that. So they're two two people that I follow, and they're in complete conflict with each other, and they're both, to me, very contrarian types of thinkers. So has me guarded about how I invest, what I do at this particular point. Both believe that the end game is going to be not good. For, it's go. Hunter wants the melt up to happen ultimately, and then a collapse. And a shift believes that we're just headed there and that there's no way inflation's going down. So the conflict is really over inflation. And up until I'd say this past week, I would say that was agreeing more with David Hunter because you started to see some of the rates go down, or the inflation rate go down. And but this past week, of course, Peter Schiff is very vocal. Both of them are on Twitter, but basically saying no, it's going up. The inflation rate is going to go up, and it's just going to get worse from here. So we'll see what happens. I mean, once it gets over 4%, I would have to go a little bit more with the Peter Schiff, um, you know, theory, that that markets will be going down because inflation rate is sticky, and then we're looking at probably some type of event happening where the Fed breaks something because they keep raising rates to try and fight inflation, and they just don't have, with 31.5 trillion in debt, they just don't have the tools to really be able to do it. And I think they both ultimately agree, but how they get there, both being David Hunter and Peter Schiff. But we'll see how it plays. Keeping a lot of powder dry at this point, especially where things sit. It's very precarious. All of these markets are sitting at a point right now that they could go either way. And David sees it as very, very bullish, the setup. And if you look at kind of the monthly chart, let's just take the SPY here for a minute. Well, let's look at the weekly first. You can see it's setting itself up, and we've broken here. Now it's getting ready to. He believes, I think, will rocket up potentially fair. There may be more downside, and maybe it hits this and goes, this downslope and goes back up. I don't know. Peter Schiff, I think, would just see this break and go down to new lows. So that's kind of where we sit, which is, I don't know. There's seems to be momentum right now to the downside, but that can change with sentiment changes, fear and greed changes, and I know both. Well, especially David Hunter talks more about how fear and greed drive things, and recommends books associated with them, all that I've actually previously read. But the investor psychology sometimes really doesn't have much to do even with the Fed. It has more the reaction of people to the events that are happening around them, and they get very fearful, they get very greedy, and they don't want to miss out. There's FOMO and greed, and then on the other side, you sell at the worst time. So that's human nature, and market makers take advantage of that particular type of thinking. So it will be an interesting week this week. I think it will, be an event here, especially on the SPY. You kind of have the same thing going with the Dow. Does it go down and, is it going to pop back up from here? It could very well happen. But it did break this cone. And so I'm expecting it kind of to come down here and hit this particular level. Does the SPY follow? I don't know. They ran together for quite a while last year, and now they've kind of decoupled. So that's what I wanted to cover this week. And remember, there is always a better way.